What are the phases of economy? The economy goes through different phases as it moves through periods of growth and contraction. These phases are often described as expansion, peak, contraction, and trough. Expansion is the phase of the economy in which economic growth is occurring and the economy is expanding. This is typically a good time for businesses and consumers, as there is strong demand for goods and services and the unemployment rate is low. Peak is the phase of the economy in which economic growth has reached its maximum level and the economy is at its strongest. This is typically a good time for businesses, as demand for goods and services is high and the unemployment rate is low. Contraction is the phase of the economy in which economic growth is slowing and the economy is contracting. This is typically a difficult time for businesses and consumers, as demand for goods and services is declining and the unemployment rate is increasing. Trough is the phase of the economy in which economic growth has reached its lowest level and the economy is at its weakest. This is typically a difficult time for businesses, as demand for goods and services is low and the unemployment rate is high. The phases of the economy can be difficult to predict, and it is not always clear when one phase is ending and another is beginning. However, understanding these phases can help businesses and investors make more informed decisions about how to respond to changes in the economy. How market behaves during each of these phases. The behavior of the stock market can vary depending on the phase of the economy. During an expansion phase, when the economy is growing and demand for goods and services is strong, the stock market may also be performing well. This is because companies are typically earning higher profits during an expansion, which can make their stocks more attractive to investors. As a result, stock prices may rise and the market may be bullish. During a peak phase, when the economy is at its strongest and demand for goods and services is high, the stock market may also be performing well. However, there may be signs that the market is starting to slow down, as economic growth is no longer accelerating. Stock prices may still be rising, but at a slower rate. During a contraction phase, when the economy is contracting and demand for goods and services is declining, the stock market may also be performing poorly. This is because companies are typically earning lower profits during a contraction, which can make their stocks less attractive to investors. As a result, stock prices may fall and the market may be bearish. During a trough phase, when the economy is at its weakest and demand for goods and services is low, the stock market may also be performing poorly. Stock prices may be low, and there may be little overall change in the market. Of course, the behavior of the stock market during each phase of the economy is not always predictable, and other factors can also impact stock prices. However, understanding the phases of the economy can help investors make more informed decisions about how to approach the stock market. Can we predict economic phases? It is not always possible to predict the phases of the economy with certainty. Economic conditions can change quickly, and the economy can move from one phase to another without warning. However, there are some tools and indicators that can help economists and investors forecast the future direction of the economy. One tool that is commonly used to predict the phases of the economy is the business cycle, which is a model that describes the recurring ups and downs of the economy over time. The business cycle is typically divided into 4 phases: expansion, peak, contraction, and trough. By tracking key economic indicators, such as gross domestic product, GDP, unemployment rate, and inflation, economists and investors can identify which phase of the business cycle the economy is currently in and make predictions about its future direction. Another tool that can be used to predict the phases of the economy is economic forecasting, which is the process of using statistical methods and economic theories to make predictions about future economic conditions. Economic forecasters use a variety of data sources, such as government statistics and surveys of businesses and consumers, to make their predictions. By analyzing this data, they can identify trends and patterns that can help them forecast the future direction of the economy. However, it is important to keep in mind that economic forecasting is not an exact science, and predictions about the phases of the economy are subject to uncertainty and error. Economic conditions can change quickly, and unforeseen events can impact the economy in ways that are difficult to predict. As a result, it is important for investors to carefully research and analyze the economy before making any investment decisions.